Most people think they know how the Great Depression began. They picture October 29th, 1929, Black Tuesday. The stock market collapses. Panic sweeps Wall Street. Fortunes disappear. The ticker tape spits out disaster faster than clerks can record it. It is a dramatic story. It is also incomplete. The crash of 1929 did not by itself cause the Great Depression. It was the moment when deeper weaknesses became impossible to ignore. The real foundations of the catastrophe had been laid years earlier in the aftermath of World War I inside an unstable international debt system, under a rigid gold standard and across an American economy where wealth was becoming dangerously concentrated at the top. To understand why the world collapsed in the 1930s, you have to begin not on Wall Street. You have to begin in the ruins of Europe. When World War I ended in November 1918, much of the continent had been devastated. France had lost nearly 1.4 million soldiers. Britain had buried close to 900,000. Germany had lost more than 2 million. Beyond the human destruction, roads, factories, bridges, rail lines, and entire industrial regions had been damaged or destroyed. Old empires were disintegrating. The Austro-Hungarian Empire collapsed. The Ottoman Empire was breaking apart. Revolution had transformed Russia. And the international financial system that had connected the industrial world before the war had been badly damaged. Before 1914, the major powers operated under the classical gold standard. Currencies were tied to fixed quantities of gold. That system created a kind of automatic discipline. If a country imported more than it exported, gold flowed outward. As gold reserves declined, the domestic money supply tightened. Prices fell. Exports became cheaper. Imports became more expensive. Eventually, trade shifted and gold flowed back. In theory, the system balanced itself. The war shattered that mechanism. Governments suspended gold convertibility because they needed to print enormous amounts of money to pay soldiers, purchase weapons, and finance industrial mobilization. Once the fighting ended, political leaders became obsessed with restoring the old system, but the world they were trying to restore no longer existed. The war had completely rearranged global finance. The United States emerged as the world's dominant creditor. European governments owed enormous sums, and Germany, defeated and humiliated, was burdened with reparations under the Treaty of Versailles. The total reparations bill eventually reached 122 billion gold marks. Economists such as John Maynard Keynes warned that the burden was unrealistic, but politics overwhelmed economics. France had suffered enormous physical destruction and demanded payment. Britain had its own debts. Both Britain and France owed money to the United States, and America wanted repayment. That produced one of the most fragile financial arrangements in modern history. Germany was expected to pay reparations to France and Britain. France and Britain could then use some of those payments to service their debts to the United States. But Germany did not possess enough hard currency to sustain those transfers, so American banks lent money to Germany. Germany used American loans to pay Britain and France. Britain and France used those payments to repay America. Then American capital flowed back to Germany and the cycle repeated. Money moved in a circle. On paper, the system functioned. In reality, it depended on permanent American lending. If those loans stopped, the structure could collapse, yet every major government had political reasons to preserve it. American politicians did not want to forgive European war debts. French leaders could not easily tell voters that Germany would no longer be forced to pay for wartime destruction. German politicians faced a population furious about reparations. Everyone disliked the arrangement. No one could escape it. And layered over this unstable debt system was another dangerous decision: the return to gold. To central bankers and finance ministers of the 1920s, the gold standard represented respectability. It meant discipline. It meant that currencies could not simply be printed without limit. It symbolized a return to the stable financial world that had supposedly existed before 1914, but restoring gold after the war created problems that did not exist before it. The world's gold had become concentrated. By the middle of the 1920s, the United States held an enormous share of global monetary gold. France began accumulating more. After stabilizing the franc in the 1920s, the Bank of France absorbed increasingly large quantities of gold from the international system. According to the source account, France's share of global gold reserves rose from roughly 7% in 1927 to 27% by 1932. The United States and France, together, were holding an extraordinary share of the world's monetary reserves. That created intense pressure elsewhere. Countries still committed to gold needed reserves to defend their currencies. When gold left, they were often forced to tighten credit and reduce their money supplies. Normally, gold standard theory assumed that countries receiving gold would do the opposite. They would allow their money supplies to expand. Prices would rise, imports would become more attractive. Eventually, gold would begin flowing outward again. France did not fully follow that logic. The Bank of France effectively sterilized much of its gold inflow. It accumulated reserves without allowing the domestic money supply to expand enough to produce the balancing effect expected under the gold standard. Gold flowed into French vaults, but liquidity did not flow back out into the international economy. The effect was deflationary. France was not alone. Other countries committed to tight gold policies behaved similarly. The system that had once been praised as an automatic stabilizer was becoming a machine for transmitting contraction. When one country tightened policy to defend gold, pressure spread to another, then another. Instead of absorbing shocks, the gold standard magnified them. And at precisely this moment, the international monetary system lost one of the few people powerful enough to coordinate a response. His name was Benjamin Strong. Strong had led the Federal Reserve Bank of New York since the creation of the Federal Reserve System. He possessed enormous influence over American monetary policy and maintained close relationships with European central bankers, especially Montague Norman of the Bank of England. Strong understood that the post-war economy was internationally connected. What happened in London could affect New York. What happened in New York could determine whether Germany could borrow. What happened in Germany could determine whether France received reparations, and all of it could affect the stability of gold. Strong therefore favored active coordination. He used open market operations and interest rate policy in ways that were still relatively new. In 1927, he supported lowering the Federal Reserve's discount rate, partly to ease pressure on Britain and help stabilize the international monetary system. That decision became controversial. Critics later argued that easier money helped fuel speculation in American stocks, but Strong believed the larger danger was international monetary instability. Then, in October 1928, Benjamin Strong died. The timing could hardly have been worse. Without him, power inside the Federal Reserve became more fragmented. The New York Fed lost part of its dominance. The Federal Reserve Board in Washington and the regional reserve banks became more influential. Internal disagreements increased. The institution that would soon face the greatest financial emergency in American history entered that emergency divided. Milton Friedman and Anna Schwartz later argued that Strong's death was a critical turning point. Economist Charles Kindleberger went even further, suggesting that if Strong had survived, the Depression might have been less severe, or perhaps avoided in its catastrophic form. Whether one individual could truly have changed history is impossible to know, but the argument reveals how fragile the system had become. Leadership mattered because the institutions themselves were uncertain about what to do. Meanwhile, the United States appeared to be enjoying extraordinary prosperity. The 1920s looked spectacular. Factories produced automobiles, radios, refrigerators, and appliances in unprecedented quantities. Productivity increased, advertising expanded. Consumer culture flourished. Stock prices climbed. Cities glittered with wealth. But the prosperity was distributed unevenly. According to the source account, by 1929, the richest 1% of American families received nearly 1/4 of all pre-tax income. At the very top, the concentration was even more extreme. The richest 0.1% earned roughly as much as the bottom 42% combined. Meanwhile, millions of ordinary families had little or no savings. For factory workers, miners, and farmers, income growth had not matched the spectacular rise in corporate profits and financial wealth. That was not simply a social problem, it was an economic weakness. Modern industrial production depends on mass consumption. Factories can produce millions of cars and refrigerators only if millions of people can afford to buy them. The wealthy can consume extravagantly. But even the richest household needs only so many automobiles, so many radios, so many meals. An economy cannot sustain mass production through luxury consumption alone. If income becomes too concentrated, demand becomes fragile, goods begin accumulating. Companies reduce production, workers lose hours, then jobs, spending falls again. The cycle reinforces itself. John Kenneth Galbraith later identified the unequal distribution of income as one of the major weaknesses of the American economy before the Depression. At the same time, many Americans were using debt to maintain the appearance of prosperity. Installment buying expanded rapidly. Consumers purchased automobiles and household appliances with credit. Middle-class families borrowed to participate in an economy whose rising productivity was not always matched by rising wages. The wealthy had another destination for surplus money: speculation. Capital flowed into stocks and real estate. Asset prices climbed, borrowing fed more buying. More buying pushed prices higher. The appearance of endless prosperity encouraged even more risk. So by the autumn of 1929, the American economy was already dangerously vulnerable. International debts depended on continued American lending. The gold standard was draining liquidity from the global system. The Federal Reserve had lost its strongest leader. Wealth was concentrated at the top. Consumer demand depended increasingly on debt, and speculative markets were floating far above the economic foundations beneath them. Then the stock market began to fall. The crash did not strike a healthy economy. It struck a structure already full of fractures. Black Tuesday would become the symbol of the Great Depression. But the real disaster was only beginning. The stock market crash of 1929 was dramatic. But crashes had happened before. Markets had panicked in 1907. The economy had suffered a sharp recession in 1920 and 1921. Financial speculation had ended badly more than once. What made 1929 different was what happened afterward. The American economy was already weak. Consumers were overextended. Income was heavily concentrated. International debts were unstable. The gold standard was spreading deflation across borders. Then the banking system began to fail. And the institution created specifically to stop banking panics, the Federal Reserve, did not respond with anything close to the force the moment required. The first major wave of American bank failures came in 1930. Depositors lost confidence. When rumors spread that a bank might be weak, customers rushed to withdraw their money. Banks do not keep every deposited dollar sitting in a vault. They lend much of it out or invest it. So even a bank that was technically solvent could collapse if enough customers demanded cash at once. One failure created fear about the next. Fear produced withdrawals. Withdrawals produced more failures. The process fed itself. The Federal Reserve had been created in 1913 partly to prevent precisely this kind of panic. It could provide emergency liquidity. It could lend to banks. It could expand the money supply. It could act as the lender of last resort. Instead, the response was fragmented, cautious, and often passive. Benjamin Strong was gone. Leadership within the Federal Reserve System was divided. Regional reserve banks disagreed about policy. Some officials believed weak banks should be allowed to fail. Others feared aggressive intervention would reward speculation and create moral hazard. The result was delay. Bank after bank closed. Savings disappeared. Credit contracted. Businesses that might have survived lost access to loans. Families frightened by the failures began holding cash rather than depositing it. The financial system started shrinking from the inside. Between 1929 and 1933, the American money supply fell by roughly 1/3. Thousands of banks disappeared. Real income collapsed. Prices fell, and falling prices made existing debts harder to repay. This is one of the cruelest mechanics of deflation. Imagine owing $1,000 if wages and prices fall by 20%. The debt does not fall with them. You still owe $1,000, but now you must repay it with dollars that are harder to earn. Businesses cut wages. Farm prices decline. Home values fall. Debt becomes heavier precisely when borrowers become less capable of paying it. Debts rise, banks suffer more losses. Credit tightens further. The economy spirals downward. Then, in 1931, the Federal Reserve made one of its most controversial decisions. With the economy already collapsing, it raised interest rates. The reason was gold. Investors were becoming nervous about the dollar's commitment to the gold standard. Gold was leaving the United States. Federal Reserve officials feared that if they did not defend the dollar's gold value, confidence in the currency would collapse. So they increased the discount rate. In other words, they tightened monetary policy during a depression. The decision protected the gold standard. It also made borrowing more expensive, reduced liquidity further, and intensified pressure on manufacturers. If foreign goods became more expensive, Americans would supposedly buy domestic products instead. More than 1,000 economists urged Hoover to veto the bill. He signed it anyway. Other countries retaliated. Canada imposed new tariffs on American exports. European governments erected barriers of their own. Trade restrictions spread from country to country. The world economy, already weakened by debt and deflation, became divided into competing national markets. International commerce collapsed. Between 1929 and the middle of the 1930s, world trade shrank dramatically. American exports plunged. Farmers who depended on overseas buyers lost markets. Manufacturers producing goods for Europe saw orders disappear. The tariff did not protect the American economy from the Depression. It helped isolate it inside the Depression, and the effects reached far beyond the United States. Remember, the financial loop created after World War I Germany needed foreign earnings and American loans to pay reparations. France and Britain relied partly on those payments to meet their own obligations. American banks provided the credit that kept the cycle moving. Now, every part of that system was breaking. American lending to Germany had already slowed. Tariffs made it harder for European countries to earn dollars through exports. Deflation increased the real burden of debts. Banks were becoming fragile. Then in May 1931, Austria's largest bank, Credit Anstalt, collapsed. The failure sent shockwaves through Europe. Depositors and investors feared that other banks would follow. Pressure spread into Germany. Capital fled. German banks struggled. The crisis then reached Britain. Britain had restored the pound to gold after World War I at a level that placed enormous pressure on its economy. By September 1931, defending the currency had become impossible. Britain abandoned the gold standard. That decision was once considered almost unthinkable, but countries that left gold often gained something important: freedom without the obligation to convert currency into gold at a fixed rate. Governments and central banks could expand their money supplies more aggressively. They could lower interest rates. They could fight deflation. Countries that remain tied to gold longer generally endure deeper economic pain. The gold standard, once treated as the foundation of financial civilization, had become a constraint preventing governments from responding effectively to catastrophe. By this point, the Depression was no longer an American downturn. It was a global collapse. Industrial production in the United States fell by nearly half. National output contracted by roughly 30%. Unemployment rose above 20% nationwide. In some industrial cities, the figure was far worse. Factories stood silent. Construction stopped. Banks locked their doors, farm prices collapsed, families lost homes, savings accumulated over decades vanished. But statistics cannot capture what that meant. A percentage does not show a father leaving home every morning pretending to go to work, because he cannot bring himself to tell his children he has been fired. A graph does not show a mother watering soup to make it last another meal. It does not show children arriving at school hungry. It does not show men standing in bread lines after spending their entire adult lives believing that hard work would protect them from poverty. The Depression destroyed more than income. It destroyed dignity. In rural America, economic catastrophe collided with environmental catastrophe. Across the Great Plains, years of intensive farming had stripped away protective grasses. Then drought arrived. The soil dried. Winds lifted enormous quantities of exposed earth into the air. The Dust Bowl turned sections of the plains into an ecological disaster zone. Dust storms blackened the sky. Farms that had supported families for generations became nearly worthless. Hundreds of thousands of people left. They packed belongings into cars and trucks and headed west, especially toward California. They hoped to find agricultural work. Instead, many encountered low wages, overcrowded camps, discrimination, and hostility from communities that saw desperate migrants as competitors. The psychological effects were devastating. Suicide rates rose, malnutrition spread. Families postponed medical treatment because they could not afford it. People died from illnesses that might have been treatable under better conditions. And the political consequences spread across the world. Economic collapse undermined confidence in democratic institutions. In Germany, unemployment and desperation helped destroy the legitimacy of the Weimar Republic. The Nazi Party exploited that despair. Its leaders promised jobs, national revival, and simple explanations for complex suffering. They offered scapegoats in Italy. Fascism strengthened. In Japan, economic instability helped empower militarists who argued that territorial expansion could solve the country's problems. The economic collapse of the 1930s and the political extremisms that followed cannot be separated completely. When institutions fail on a massive scale, people begin looking for alternatives. Some of those alternatives can be dangerous. That is why the Great Depression cannot be understood as merely a stock market story. The stock crash mattered. Speculation mattered. But the Depression became catastrophic because failure reinforced failure. World War I left behind unstable debts. The reparations system depended on continued American lending. The gold standard forced countries toward deflation. The United States and France accumulated enormous gold reserves. Benjamin Strong's death weakened monetary leadership. The Federal Reserve allowed the money supply to collapse. Bank failures destroyed savings and credit. Smoot-Hawley helped crush international trade. Extreme inequality weakened consumer demand. Debt magnified the downturn. Each problem made the others worse. No single cause explains everything. That is precisely the point. The Great Depression was a systemic failure, and many of the people making the worst decisions believed they were behaving responsibly. Central bankers defending gold believed they were protecting monetary stability. Politicians raising tariffs believed they were protecting domestic jobs. Federal Reserve officials allowing weak banks to fail believed they were enforcing discipline. These were not necessarily irrational people. They were trapped inside ideas that no longer fit reality. That may be the most important lesson. Economic disasters are not always caused by ignorance. Sometimes they are caused by intelligent people applying the wrong framework with absolute confidence. The Great Depression eventually forced governments to reconsider nearly every assumption that had shaped economic policy before it. Deposit insurance was created, banking rules changed, countries abandoned rigid commitments to gold. Governments accepted greater responsibility for unemployment and financial stability. International institutions built after World War II were designed partly to prevent the debt, trade, and currency conflicts that had torn the interwar economy apart. But those reforms came only after enormous suffering. So when someone says the Great Depression began because Wall Street crashed in 1929, the better answer is more complicated. The crash was the moment the weaknesses became visible. The disaster came from what followed. Banks failed. Money disappeared. Trade collapsed. Governments defended old rules. International cooperation broke apart. And policy mistakes turned a severe recession into a worldwide catastrophe. The most important question was never simply why stocks fell. It was why institutions failed to stop the fall from becoming something much worse. That is what made the Great Depression historic, and that is what makes its lessons dangerous to forget.